Hi, everyone, and welcome to Investor Training with 1000 Angels. I hope you're all doing great today. I want to thank everyone who's made it to join us and apologize for the need to reschedule from yesterday. Hopefully this is still a good time for you, and can't wait to talk to everybody about this really exciting topic, startup term sheets and securities. So before we get started, I just want to let everyone know, that I completely understand how difficult this time is for people around the world and in the US, and particularly for startups that were in the process of trying to access the capital markets, as well as investors who, just have complete uncertainty around what's happening for themselves and their investments over the next few months and potentially year. But at the end of the day, we kind of have to move forward. We have to all stay calm and keep our wits about us, and to really remember that, some of the best opportunities actually come out of adversity. And it's, a really good time to be thinking about taking some time to educate ourselves, to dive deep into topics that we normally might not have time to explore. And this is particularly one of them. So I just want to thank you guys once again so much for joining me today. And without any further ado, I will be jumping into the material. So let's share the screen. Okay, give me a quick second. No. There we go. All right. You should be able to see my screen now. Great. So welcome everybody to the 1000 Angels Startup Investing Masterclass on startup term sheets and securities. So this is kind of an interesting section of our course in that, we dig deep into a little bit, sort of more technical issues around startup investing. And, I think that this is really, really such an important topic to cover, because most people out there who are interested in startup investing aren't necessarily 100% aware of the different securities that we use to make startup investments, and why we use unique securities in this specific section of the capital markets. So, you might be an accredited investor, and doesn't mean that you passed any exams or have a certification. It literally is just kind of a test of net worth as well as potential income. But even for folks who are accredited investors, who are financial services professionals, who are bankers, most people are not really familiar with the types of securities that we use at the early stage. And a big reason for why, even those folks are not familiar is that a couple of the main securities that we use to invest in startups, one is called, a convertible note. The other one is preferred equity. These names are actually used for securities in the public market, but when those securities are issued by public market companies, large companies, they actually have almost a completely opposite effect of what they're meant to do at the early stage. So we're going to dig into a little bit around, what do these securities mean at the early stage, and why do we use them? So moving on. So just to introduce myself, for anyone here who doesn't already know me, I'm Erica Dignan-Minahan, co-founder of 1000 Angels and Reinventures. Obviously, 1000 Angels is a platform for accredited investors to build a portfolio of direct investments in companies at the seed and Series A stage, and Rain is our fund version of our seed and Series A to Series B investment vehicle. I've actually spent over 14 years investing in early stage companies. I've had roles as executive director of Golden Seeds, managing director of Dream Adventures, and several other roles as an investor over the course of my career. Prior to getting involved in early stage venture capital, I actually was an investment banker for about 8 years. And since then, I've invested in well over 100 early stage companies and worked with thousands of early stage companies that are looking to raise capital. I have my MBA in finance from Columbia Business School, where I also teach a course on venture capital, as well as a degree from UCLA in business economics. So before we jump into the slides, I just want to do a little bit of housekeeping. which is to let you guys know that if you want to ask questions, anytime during the lecture, we want to keep this fairly interactive. Feel free to use either the chat or the Q&A function to ask me a question. And in fact, it might even be a little bit easier for me to see the chat function. So just open your chat, throw a question in there, stop me as I'm going along. Happy to answer your questions as we go. So our agenda for today. So we're going to start off with kind of just like an overview of term sheets, and where they're used, what they mean. Then we'll go into some of the important provisions that you need to look for in an equity term sheet. And then, trends in seed stage securities, because things actually have changed quite a bit over the last few years. So we're really going to be focusing more on which technical securities are used rather than kind of like valuation trends and things like that. If you're interested in learning more about valuation trends, we actually did a session back in November called Startup Valuation Explained. So I might actually send a link out to folks to the recording of that as well, in case people want to see, what are the securities being used, and also, when we actually look at what's actually in the term sheet, what are the terms, what are the trends in valuations and other terms. So starting off with term sheets, basically, what do I need to know, right? So number one, there are a few different types of securities that we use. So the one that you might be most familiar with that's been used for early stage funding, I think for probably the longest period of time, is a convertible note. Technically a convertible note is supposed to be like a really simple, easy to use security that doesn't require, a ton of lawyer involvement or documentation. And so generally, because it's like fairly easy to read, it usually doesn't have a term sheet. So what is the actual purpose of a term sheet? Well, if you've ever invested in preferred equity, that the document is very, sort of long and complicated. And so what a term sheet does is hopefully sort of outline at a very high level in plain English, exactly what is happening, within that security, right? So let's just go through a high level and, actually write down, okay, what are all of our main concerns that we need to agree on? And, let's do it in plain English before the lawyers start drafting it and it gets really hard to understand. So that's kind of the purpose of a term sheet. So generally, a convertible note doesn't need to have one. Occasionally, somebody might put one together just to make it even more simpler, but you're usually not going to see one. The next type of security that you're going to see is, of course, common stock, which would be for a C corporation or LLC membership shares. So these are typically not used for startup cash investments. And we'll talk a little bit about why, but basically what it allows, the company and investors to do is to actually share the proceeds of any liquidation or sale pro rata. Okay, so generally, as an investor, and if you can ask any other investor, it's highly recommended not to invest in common if you're actually putting in cash. We need to actually differentiate ownership between people who have actually invested cash and people who have invested sweat equity or, some other form of interest in the company. So the next type of security that is actually the most common for, I would say, rounds of 3 million or more, so by the time, you sort of get to a venture fund level, is preferred equity. So that's generally what we're going to see for larger rounds. You get a dividend usually. It's not paid out in cash, but you might have a preferred return on your security for the time that it's outstanding. You have a liquidation preference, and basically you'll either have the option to redeem your principal plus your preferred return or convert your entire share into equity. So that's the most common type of early stage equity security, and what we usually require companies to give us. So when you invest in a convertible note or some other kind of early stage security, the expectation is that it will eventually convert into preferred shares once the company actually does a round large enough to sort of support the expense of actually issuing preferred shares. So there is actually a fourth type of equity security that we may see coming back. So it's really funny because I do these webinars all the time. And, you know, like I said, I've been doing this type of investing for a little bit over 14 years now. And back in the day, when the environment was what we would call investor friendly, which it hasn't been for the longest time, we actually had another category of stock, which I would usually talk about during these webinars, but they would seem like this, you know, mystical unicorn that, you know, nobody had seen in so long. Like, why would I was like deleted it from the slide because I literally haven't seen participating preferred in so long. But times they are changing. So my guess is that the old participating preferred might come back. So it's really the most investor friendly type of security. It's basically preferred stock, has all the protections of a preferred stock, but kind of allows the investor a little bit of what we call the double dip. And so in this double dip, what that means is that as an investor, you first get the return of all your principal and your preferred dividend, right? Which basically just compensates you for what you put in and the time value of money. But then you also convert that principal and accrued dividend value into common shares pro rata. So you get all your money back plus your time value of money, and then you also get the equity. So the reason that investors, you know, in an investor-friendly environment are able to convince startups that this is fair, and, you know, I definitely do see why there's some fairness to the participating preferred, is that as a founder, until you get, you know, all your money back, plus, you know, whatever you're being compensated for time value of money, and usually the preferred return is somewhere around like 6%, you know, you're still not made whole, right? So the idea is, hey, let's all get back to zero, right? Get back to even, and then we share in the gains. So there's a good chance that in this environment, we might see the participating preferred equity come back. So moving on to some details on these securities. So the convertible note. So what do we know about it? First of all, typically it's supposed to be simple enough that it doesn't involve a term sheet. You know, it's supposed to be a simple document. The idea here is that it can be drafted by a lawyer for hopefully less than like $5,000, $10,000 in legal fees. You know, obviously you have the principal amount of the note on there. You have some sort of a valuation cap, right? So that's the maximum valuation at which the note will convert into equity. You have some sort of a discount. The discounts on notes typically market is 20%, you know, and that's like pretty standard. So, you know, for example, 25 would feel like, oh, wow, that's, you know, a pretty attractive discount. I have seen companies, you know, put notes out there and randomly be like, the discount is 10%. You know, I think just doing something like that is almost like insulting to the investor, because, you know, it's like, why would it be less than 20, right? 20 is a pretty standard one. As far as the interest rate, which is kind of like building that preferred return into your note. So on a note, it's called interest rate. On the preferred equity, it's called preferred return. That's generally between 4 and 8%. I would say 6 is typically the median. And then you have the conversion condition. So what are all of the triggers under which this converts? Usually it's when the company raises a qualified round of $1 million or more. And then some optional conversion or redemption language and a maturity date, right? So at a certain point, if the company hasn't done a qualified financing, you know, it will mature and supposedly convert into equity. So the important thing here is to realize that the purpose of the convertible note is not to act as a debt instrument, but it's actually really to convert into equity at a future date, right? And so this is one of the issues that people actually have with convertible notes, is that they're sort of written to look like a debt instrument, but they are completely not a debt instrument, like at all. They're supposed to be equity. You know, you should never be under the false impression that, you know, this means that the company is going to pay you back your money at a certain date. And in fact, if the company were in the position to pay you back your money at a certain date, you probably wouldn't want them to pay your money back, because it's probably because the equity is more valuable. So we're going to talk about the dangers of convertible notes and why they've kind of fallen out of favor. So number one, right off the bat, this is kind of like investing, 101, never invest in an uncapped note. The note always has to have a valuation cap on it. Because otherwise you won't be compensated for the risks that you took during the time that, between when you invested and when the company does their next round. So that's number one, stay away from uncapped notes. Number two, always make sure that you have optional conversion. So optional conversion means that make sure that you have the option to convert the note at any time. And this is why people don't, get a little bit nervous around convertible notes, is that sometimes the language can be a little confusing. The lawyers have gotten in there and written a lot of weird stuff, and they could accidentally write in that the conversion is at the option of the company. You want to make sure that everything is at your option, so that you have the option of saying, okay, either I want to ask to be paid back, which is kind of ridiculous, probably not going to happen, or I want to always have the option to convert at such and such a price. So we have a question from Mariana. How do startups decide whether they should do safe with discount versus valuation cap? Okay, so we're going to get to safes kind of towards the end. So thank you for that question. We're going to get to safes later. So on convertible notes, there should be no optional redemption for the founder, obviously, because you don't want to, so for example, let's say, I'm just using round numbers. You invested $1 million in a company when it was very early, and you invested in a convertible note with a 2-year maturity date. And then, in the middle of that 2 years, the company, something amazing happens to the company. It's now worth $100 million. They get an acquisition offer. If the founder has the option of redeeming your shares, they can literally just be like, oh, thank you for the money. Here's your $1 million back plus, whatever the interest rate was. And you essentially will not participate in the upside. So that's what we have to be really careful about, is not making sure that we've not accidentally invested in a note where the founder has the option to redeem the note, at principal plus interest for any time. The next thing is, and this is again becoming relevant because we're going to enter a capital constrained environment, is be aware of really aggressive discounts. So if you're investing in a note and it's got a 40% discount or something like that, you might think, oh, that's really attractive. I'm going to convert into equity at 40% lower than the next round. What will usually end up happening is that when it comes time for your notes to actually convert, the follow-on investor who's putting additional capital in is going to say, oh, well, that's ridiculous. Why is this person converting in at, such a lower price than I am? No, I insist that for this deal to go through, we renegotiate it to X, Y, and Z. And that will almost always happen. I know that it seems unfair, but at the end of the day, last money in kind of controls everything. So it's sort of better to be in a situation where the discount is market reasonable. It's not overly aggressive, because all that's probably going to happen is they'll renegotiate on you. And then also know what you're going to convert into. So you want to make sure that the note is not converting into common, that it's going to convert into the preferred of the next round. So very important. Next is, even though it's a note, you want to make sure you get information rights. That means, hopefully the company is committed to providing you quarterly updates and an annual sort of more robust update with financials. And then another thing too that's tricky about convertible notes is that conversion premiums are usually a good idea. So, you could have a situation where, for example, let's say, you invest in a company and $1 million is invested and the valuation cap is something like $8 million, right? So, if let's say the valuation cap is 8 million, and then the company, you raised $1 million, they decide, the founders get an offer to sell for, I don't know, 12 million or something. In theory, you would basically get a 50% return on your investment, but, the founders are probably walking away with much, much more money. So what conversion premiums do is they say, okay, if this thing gets sold before the maturity date, and you're going to make a lot of money, I want to make sure I get like at least 2x, right, on my investment. So, you know, if it happens, you know, within 12 months, I want 2x, you know, within 18 months, I want 2.5x. So they're just another thing that's like a little bit protective in a note to make sure that if there's an early exit, that you're still able to you know, profit a decent amount, even though, you know, a 50% increase is great. You did do sort of all this work on the deal, and, you know, they're kind of selling early. These are securities that we expect to, you know, have sort of 10x upside. So conversion premiums can be helpful in a note. And so, you know, one of the things about notes that's like people don't love is that, you know, you technically don't yet own the equity. You are not on the cap table. And as I said, you know, the danger here is that with notes, it's weird. It's like things can be renegotiated, you know, much more easily for some reason with convertible notes. So you technically don't really own the equity, but also it's not really debt. So that's why people, you know, have been not so keen on convertible notes. There's a million reasons. And why, as Mariana said, there's this other thing called the SAFE that's become much more popular. So we'll be talking about that in a minute. So common stock, let's talk about why we don't do common stock, right? So common stock or LLC membership, basically there's no downside protection of your principal. Like once your money goes into that company, you know, that cash is shared with everybody. You know, as far as an outcome, it doesn't really matter that much if there's kind of like binary outcomes on the company. Like this is either going to go to 0 or be a billion. At the end of the day, it doesn't matter. But, you know, for most companies where there aren't super binary outcomes, we want to have some protection. That's why we use the preferred. And then, of course, you know, we actually have done investments in some companies that are LLCs. So where there are pass-through tax benefits, that are material, you know, then it actually makes sense. But for like sort of like, you know, with real estate type companies or companies that generate cash flow or can pass along losses, you know, that can be beneficial. But for like a traditional sort of, you know, tech startup type of company, we don't really want to do that. And most VCs don't invest in LLCs anyway. So you really have to be thoughtful as to the type of company that you're investing in. But at the end of the day, if the exit is huge, the difference is minimized. So, you know, there are some, you know, types of VCs out there, you know, that maybe historically have, you know, in very founder-friendly environments have been okay with investing in common stock because, you know, they're kind of looking at a huge binary outcome. So the next one, which is preferred equity, has definitely been the most prevalent security historically. I would say the last 10 years is basically what everybody invests in. Like I said, participating preferred could have a comeback. So we'll see, and we'll talk about it a little bit, but let's focus on what has been the most common. So I just want to be really clear that you may have heard about preferred equity in public markets. So the thing that's sort of confusing about public market security is like they issue something called preferred equity, but their preferred equity basically acts like debt, right? Whereas this does not. This is actual equity. You're going to see a term sheet for this. You're going to see, you know, the price of they're paying for the shares, the total number of shares outstanding. There'll always be usually a pre-money valuation on the term sheet or in the documentation. Sometimes when companies get to like Series B, usually they'll do a post-money valuation instead of a pre-money. But usually it's a pre-money valuation, so the valuation of the company before the money goes in. There'll usually be some sort of preferred return, and so, you know, historically that's been between 4 and 8%. You know, I would say that it hasn't been closer to the 8 in a long time. It's been more like 4 to 6, I think, because of sort of the environment that we've had. But, you know, over time, it's sort of 4 to 8. And then, of course, there are liquidation preferences. So liquidation preferences means, you know, how many times the principal invested is the investor entitled to, you know, when there's a liquidation event, right? So we've seen liquidation preferences over the last 10 years of pretty much only 1x. But I will tell you that When was it? Yeah, I guess probably like 2008 to 2010, right after the financial crisis. You saw liquidation preferences get crazy. It would be like 2 to 4x, right? So as an investor, you might think, oh, wouldn't that be amazing? Like I'm guaranteed, 4x return on my money before the founders even get anything out. But the reason that it actually sort of ends up being dangerous is that it does really disincentivize the founders, because basically like they can't make any money on the business until they've, provided you as an investor with like 4 times the return. So it makes it, just it's hard to really get the founders on board to work really hard to maximize the outcome, since they have such a hurdle to get over. But it's something that you absolutely see go from 1 to integers larger than 1 during any sort of like a financial crisis environment when people are really desperate for money. So we'll probably see, the resurgence of increased liquidation preferences. And then all the sort of like investor rights and provisions that you typically see, which we'll kind of go through one by one. And I just want to let you guys know, I'm going to send after the call, like I'll send you guys a recording of the webinar, but I'll also send some like basic kind of documents that outline, sample term sheets, sample safe, sort of explain all the different provisions. So you'll sort of have it to look at more closely after this. So let's look at what does this mean, right? Like in terms of actual money. So, and particularly we're going to look at common versus preferred versus participating preferred. And, why do we care about, these different securities? What are this? We'll do a little scenario analysis as to what are the different outcomes under different situations. So the preferred versus participating preferred, it's going to provide for return of capital and dividends before distributions to common shareholders. Both of them do that. But participating basically allows you to double dip. It lets you get your capital and your dividends and then also share in the common. And this is really most critical just in what we call lackluster outcomes. So if the company sells for like a ton of money, doesn't really make a huge difference. If the company just does crap, it doesn't make a huge difference. But where it really makes a huge difference is if the company just has like, a BS outcome of, maybe they sell for like $5 to $10 million. It's, not what anyone hoped for, but it's not terrible. So we'll use this example of a $1 million investment at a $4 million pre-money valuation with a 5% preferred return. And let's say that the company, takes 5 years to exit. So let's take a look at what happens under these 4 different scenarios and when the different types of securities are most important. So pre-money valuation was 4, investment was $1 million, post-money in the company was 5, pretty standard terms. Let's say that there's a terrible outcome. The company sells for only $2 million. So if the company ends up selling in 5 years for $2 million, unfortunately, if you were in common stock, you would get $400,000 back, which is like pretty terrible. You've now lost 60% of your investment, but that's where you would end up. However, if you were in preferred stock, you would get 1.25 million, which is, not great for a 5-year investment, but whatever, you're protected. The founders end up only getting 750. But if you had participating preferred, you get about 1.428 million. So you're going to do materially better in the participating preferred than you were in the preferred, but it's not like the hugest difference. Both the preferred and participating preferred are going to cover you pretty well in a downside scenario, whereas with the common stock, you're like, you get absolutely screwed over. So that's why we don't like to be in common. If we look at scenario 2, where the company sells for 5 million, which was the post-money valuation of the same round, so basically created no value, with common, you're just going to get your $1 million back. So, you gave somebody $1 million 5 years ago, you just get the $1 million back. You've basically not even been compensated for time value of money. In the preferred stock, you'll get the same 1.25. And with participating preferred, though, here's where it gets valuable, is that you'll actually get 2.14 million. So this is actually much more fair because, if you think about it, right, the founders are getting to keep sort of, you know, almost $3 million. So, you know, the people who invest in participating preferred are also coming away with actually some return on their investment beyond just time value of money. It wasn't a terrible scenario. The founders are walking away with some cash too. So it kind of presents, you know, in this scenario, really the most fair outcome. Whereas, you know, in a common stock scenario, you'd just be getting your money back. So technically you lost for time value of money. The founders would be keeping 4 million. Same thing in the preferred stock scenario, you'd just be getting compensated for time value of money and the founders would be walking away with 3.75 million. So you might not feel like super good about that. But in a scenario where you had participating preferred, where you're walking away with, you know, 2.14 and they're walking away with 2.85, you might feel that that's more fair. So that's sort of an example under which, you know, it really comes into play. Similarly, with a $10 million sale price, you would see the common exiting with 2, preferred exiting with 2.4, and participating preferred exiting with 3.3. So we can see here that in that sale price range, the participating preferred still provides you with a tremendous amount of protection to preserve upside in the company. And then as, you know, the sale price gets higher and higher, the difference between common, preferred, and participating starts to get narrower and narrower and less meaningful. So this is how, you know, some of these sort of California VCs sometimes justify investing in common stock, is that, you know, yeah, if you're expecting the company to sell for hundreds of millions of dollars or $1 billion, it's not really going to make any difference whether you invested in common or preferred or participating preferred. But if for whatever reason there is a lackluster outcome, you'll see there's a huge difference in what you actually get. So moving on to important provisions that we need to think about. So the first one is, of course, your voting and protective provisions. So these are all the things that protect the investor class, right? Which is typically at this point a minority investor. So, you know, because technically in early stage rounds, usually anywhere from like 20 to 33% of the company is sold at any one time. The investor class is almost always a minority investor. So in theory, they wouldn't have control. So we have to sort of put in these voting and protective provisions to make sure that, you know, the investor class has some say over, you know, major events that happen with the company, and that, you know, the common shareholders who have control can't necessarily just run roughshod over them and, you know, make changes without their authorization. So usually a majority of the preferred equity share vote is needed to make material changes to anything in the company. And that means, you know, new security issuances, liquidations, distributions, any sale or change of control. So it allows you to be a minority stakeholder in terms of overall percentage equity in the company, but to still have control over, you know, large decisions that are happening. That's why it's so important. So the next is information rights, right? And this is actually very important. So it outlines like what information the management team is obligated to share with you. Unfortunately, you know, as angel investors, it's sometimes reserved for major investors. But I think it's really important, you know, even if you're not a major investor, and major investors is always going to be defined in the term sheet, it's usually like 250K or more, that even if you're not a major investor, that you have some understanding that, you know, I'm entitled to quarterly updates and probably an annual, you know, more robust update with financials, et cetera, you know, all that kind of stuff. But whatever rights to information you have is actually going to be outlined in your term sheet, in your investment docs. And it's really important to understand this, that as an investor, you know, you're not entitled to just like bug the CEO at any time for information. You know, there should be sort of a pre-arrangement of, this is the information that you're going to get, and here's the frequency and you know, depth within which you will receive that information. So the next one is preemptive or pro rata rights. So this is actually really important, but also unfortunately like a little bit difficult to actually enforce, which is kind of funny. Like everything here can be a little bit difficult to actually enforce, but at least you know, you asked for them and you got them up front. So what these do is it ensures that you can maintain your percentage ownership in the company through future dilutive rounds, right? So if, you know, you made an investment in the company and you now own 2% of the company, your pro rata rights will give you the opportunity in future rounds to be able to continue to own up to 2% of the company. Sometimes it's only available to major investors. It can also be known as right of first offer. There's right of first refusal, but it's very, very important if the value of the company takes off. So an example would be that, you invested in a startup, the startup was small, maybe you were part of $1 million round, let's say it was $1 million at a $4 million pre-money valuation. So in theory, your investor class owns 20% of the equity. Now, let's say that, something happens over the next year where all of a sudden, like, that startup is now like the hottest startup on earth, and everybody cool is like dying for a piece of the company. So in theory, the existing investors already own 20% of the company, but they want to bring in cool VCs. They want to bring in Sequoia and First Round and Excel and, all these like cool new investors that are, begging for a piece of their company. Well, there's only so much of the company that they can sell. And in order to make room for these cool new investors, they've got to like dilute some of you. And you may not want to be diluted because now the company is doing really well. So, this is one of those situations where it's very important, like as the value sort of takes off in the company, but also, why it's also really important to make sure that you maintain a really good relationship with your founders, because if for whatever reason they don't have a great relationship with you, it's very easy to get like cheated out of your pro rata rights when a company becomes really hot. So just something to like really be aware of and to take very seriously, and to be sort of proactive about, to make sure that, if you end up in this situation, and these situations are very rare, that you're actually able to exercise your pro rata rights as you see fit. The other thing too to remember is that, your pro rata rights are yours in theory. So if you say did have pro rata rights in a company that's value is taking off substantially, and maybe, you would need to invest another $100,000 in order to monetize your pro rata rights, that, and they're very valuable. Even if you don't have the $100,000, you might want to think about, there are some other firms out there that I can maybe offer my pro rata rights to, where, they'll give the money for me to actually exercise the pro rata, and I can take a little bit of the upside to be compensated. So it's something to kind of like familiarize yourself with, and just to make sure, that you actually ask for in a deal. So the next we have are drag along and tag along. So tag along means that you have the right to participate pro rata in any sales of equity by common shareholders at the same terms. So this prevents founders from, selling a bunch of their common equity at a really high valuation, and not, allowing you the opportunity to also get some liquidity. So usually the tag along rights, will be able to be exercised in most cases. And then, drag along also means that, a minority of stakeholders can be compelled to sell their shares in a transaction approved by the board and a majority of the common and preferred stakeholders. So for example, if Microsoft wants to acquire your startup, and, the common shareholders have all agreed, and 80% of the preferred shareholders have agreed, and there's like 20% of the preferred shareholders, maybe it's one guy who says, oh, I don't want to sell, it's ridiculous, price isn't good enough. That person can be compelled to sort of be dragged along, right? So it doesn't allow one minority of the preferred class to hold up an acquisition based on, just sort of being difficult. So tag along and drag along rights are things that you're going to see pretty frequently in investor provisions as well. And then the next one, which is anti-dilution, is a little bit more complex, and I'm unfortunately not going to be able to have time to really dig into the math, because mathematically this is one of the ones that's a little bit harder for people to calculate than others, but we'll do sort of a basic overview. So essentially what it does is it is there to mitigate the effect of a down round. So a down round just means that the company is raising money at a valuation that is lower than the post money of the previous round. So we have a couple different ways of calculating anti-dilution. One is called weighted average. And here's the formula. It's, whatever, I'm not gonna read the formula to you, but you have it on this page. And, I think I might actually have a document that sort of details the formulas. But basically it kind of like says, okay, on a relative basis, what is the average of the price paid in the previous round versus the weighted average of the price paid in this round? And we're going to reset all your shares at that price. So it takes into account the size of the previous round, the size of this round, and the differential between the prices to help you sort of just, have a new price that's like kind of in the middle. So you're going to get some more shares, but you're not going to be like completely repriced at the new price, versus something called full ratchet anti-dilution, which, we have not seen at all in the last few years because, investor friendly environment, is where your shares are repriced completely at the new lower price. So you get, the total number of shares you have as an investor is increased as though you originally purchased them at this new lower price. So if you paid $10 a share for your shares 2 years ago, and now they're selling shares at $6 per share, they go back and they say, okay, whatever money you put in, let's say you put in $600,000 before, they're going to say, okay, now you have, 1,000 shares, right? Or sorry, 100,000 shares. So everything will be repriced, and it's, very very investor friendly. But the problem is that this type of full ratchet anti-dilution can be so dilutive to founders. It basically like wipes out all the founders' equity. So, number one, we don't want founders to sort of be completely diluted out of their startups. It's not helpful to anybody. And also, if the new round is small, right? Like let's say, when you were selling it at $10, when the founder was selling at $10 a share, they were raising $1 million. And now at $6 per share, they're only raising maybe like 200,000 of emergency cash kind of at a low price. That would be unnecessarily punitive, right? Because, the previous round was kind of a lot. The new one, yeah, the price is a lot lower, but they're not raising a ton of capital. So there's no need to sort of reverse dilution so aggressively. So that's why you pretty much don't ever see full ratchet anti-dilution for those reasons. Most people will go with weighted average, which takes into account that we're going to kind of average it, and then we're also going to take the size of each round into consideration. So here's just sort of a little example of different anti-dilution provisions and like what happens. So let's say that the Series A price for this company was $2, and then they did their Series B at $1 per share. The total Series A was $500,000 and the Series B was $1 million. So if we look at sort of what is going to happen after the Series B, you'll see that, okay, pre-Series B, the common had 750,000 shares, the Series A had 250,000, and, there's $1 million total. When we go and sort of adjust for this anti-dilution, we'll see that the Series A folks get an additional 125, and post Series B, they've got 750, 375, and $1 million. So basically, they're going to get their shares increased a little bit because, even though they didn't put additional money in, because now shares are being sold at a lower price. So basically, with anti-dilution protections, the Series A folks now have 17.65% of the company. And if they had not had these anti-dilution protections, they would have been diluted down to only 12.5%. So what it does is it basically like mitigates the extremely dilutive effect of a follow-on down round. So you can see that it's quite material, whether you own, close to 18% versus 12.5%. So moving on to Mariana's question, what are the new trends in securities? So over the last, I want to say probably 6 years, we have had 2 new securities come on the scene that are really interesting. One is called the KISS and one is called the SAFE. And I think that, they were both created around the same time. And I think that we see the winner has clearly been the SAFE. So what is a SAFE? It is a simple agreement for future equity. It is an investment document that was created by Y Combinator. Y Combinator has to do like hundreds of investments each year. And they were like, we need just one really simple standardized security that makes a lot of sense. they obviously saw all of the dangers and problems with convertible notes. They were like, you know what, this is silly. Why are we pretending this is a note? You know, let's just make a security that really is designed for startup funding, early stage funding, kind of preferred equity, and, you know, just have it be really standardized. So I'm a huge fan of the SAFE. I think that, you know, at first I was like, why are all these companies not in Y Combinator using it? But now that, you know, I've kind of worked with it for a few years, I actually think it is the best security for companies to raise on before they actually do a preferred equity. So, you know, these are all equity versions, because at the end of the day, like, none of these early stage investments can really be considered debt. I mean, these companies don't really have any assets. So there's no repayment option, there's no interest. It usually just has a discount. I mean, at first it was like discount or cap or both or neither, but like seriously, you should always make sure that it has a discount and a cap. It's going to convert at the next qualified round. If there's an acquisition, it's going to convert at the cap. If there's an IPO, it's going to convert at the cap. There's no maturity date, and you get information and pro rata rights. So very simple security, very standard. I mean, one of the main reasons people like these things is that, like, you don't really need a ton of legal hours to use them. And in fact, I mean, not offering advice, but a lot of people would say that you don't even really need a lawyer to be involved, because it's very plain English. You know, it's very clear. You know, you might want to maybe spend a teeny bit of time with your lawyer, but it's not going to be nearly as expensive as having them draft a convertible note, which needs a note purchase agreement, and it needs the note and all sorts of lawyers involved. And clearly it's much cheaper than preferred equity, which it can be very expensive to issue. So we love the SAFE. I'll be sending everybody a copy of the, you know, standard SAFE agreement, as well as a little primer that explains how it works. The next one, which was started by 500 startups sort of as a competing document, is called the Keep It Simple Security. I would say that this did not really take off. The Y Combinator SAFE is obviously the clear winner, but who knows, you may come across this. They made it with debt and equity versions. So the debt version had an interest rate and repayment option, which is like, why would we want that? So silly. The equity one has no interest or repayment, but it kind of operated, you know, in a similar way. But I literally haven't seen a KISS in years. So we can move on from this page. So why has the SAFE come out as the clear winner? Well, it's very simple. It is a simple agreement for future equity. And that is literally what people were trying to do with a convertible note. But just like calling it a convertible note makes it seem like, oh, what is this? Like, you know, am I lending the company money? Is this debt? Like, why would we even create an instrument that was meant to be a simple agreement for future equity, but disguise it as some sort of a debt instrument, right? When it's really not. So this reflects what it actually is meant to be: a simple agreement for future equity. The investor is making a cash investment and will get company stock at a later date in connection with a specific event. That's it. So it's very clear that it's not a debt instrument. It's a great alternative to convertible notes because it's just a lot simpler, and it just more clearly reflects the actual purpose of the instrument, is that you are investing in equity, but it's just like you're actually going to get the equity at a later date. So why SAFE versus notes? So technically debt instruments have requirements. So there's like regulations, there's interest accrual, maturity dates, like, you know, all sorts of weird things that can happen with debt. So it's just like there are a lot of sort of unintended negative consequences. Also, it's very easy that, you know, somebody could invest in your note and pretend like, oh yeah, I thought this was like debt. You know, you owe me the money back, right? When that's really not what you're trying to do. When you raise, you know, early stage capital for a startup, you probably don't have the intent of like paying the investor back the money plus interest. Like the intent is that, okay, this is going to convert into equity at some time in the future and you have an interest in the company. So we sort of avoid all these, you know, unintended negative consequences by actually issuing a SAFE and being really clear about it versus issuing a note, hoping that it's going to have that effect. So the SAFE is also intended to be really simple for both companies and investors, right? And usually all you really have to negotiate is the valuation cap and the discount, right? Everything else is kind of very clearly outlined, you know, very simple, very standardized. So it's only two things that we have to worry about. And because it's so standardized, This just is a less uncertain document. I mean, I've definitely gotten convertible notes from companies where there was all sorts of crazy language in there that, gave them a repayment option or did this, or, it was just like very, very difficult to actually understand, like, what is this thing saying? And so you ended up spending, hours and hours of time trying to parse what it meant. And protect yourself, as well as, the company spending a ton of time on lawyers, having lawyers redraft it, whatever. So this is just very good. It just makes it very clear and very fast, and hopefully allows you to actually execute the raise with basically like zero transaction costs for both companies and investors. So at the end of the day, both the company and an investor should be able to read a safe like pretty simply and understand what's going on. Like we said, you don't need to hire a bunch of lawyers to do it. So if we look at the current market, I'm going to pull some examples of some of the companies that we're actually raising money for right now, and what type of securities they're using. So we can see that, people are still using all different kinds. So for example, we have this really great company that we're working with right now called Stylist. They have actually created amazing technology that allows you to text, like shop by text, right? So you can download, create a profile, download, make an account, and essentially shop from Instagram or by text, whatever you want, right? So sort of like a personalized shopping experience, completely by mobile. And, they've actually been really successful as a result of coronavirus, because so many people need to, get basic supplies, right? So it's a very easy way to say, hey, send me a case of hand sanitizer or toilet paper or whatever. They'll go out and actually find it for you at the best price. So really cool company. They are raising on a convertible note, right? So whether or not, you're raising on a convertible note, on a safe, whatever, we still kind of have the same, analysis that we have to go through around what the company is doing and what their potential is. So, this company is currently raising about $2 million. We're going to assume that, eventually they're going to do a future raise. It'll be dilutive of maybe say like about $5 million. And so, whether or not they're in a note or some other security, we still are going to assume some sort of expected return on the company. For example, with this company, we're looking at a potential return of about 20x. So, that assumes that we think the company can be worth at least $300 million in the next, 3 to 5 years. Knock wood that she gets there. That's based on their projections. And there's eventually a potential for a 20x return. So I want to like highlight this particularly to the investors, but also to the founders in the room, which is that the cost of capital at the early stage is supposed to be very high. And so what you will see for expected returns for companies that are raising kind of like seed rounds through Series A is anywhere from 10 to 40x returns on investment. So cost of capital is supposed to be high. It's not, oh, I'll give you twice your money back. It's like probably at a later stage Series A, it would be more like a 10x expectation. On the earlier side, it can be anywhere from like 30 to 40x. So really sort of understanding what the market is in terms of, okay, if I think that I can sell, this company for, 300 million, right, in 5 years, it probably can't be worth more than like $10 million post money today, right, around there. So that's sort of how we get to what the market is. Another one that we're working on, amazing company called Snowball Wealth. They are working to solve the debt crisis. So student debt, credit card debt, all of that stuff, really targeting millennials, helping them improve their financial health. She is using a safe. Not surprised, Northern California-based company. Safes are very, very common there for very good reason. So, we have some people using notes, some people using safes. Same thing here. When we analyze the investment, we think, what's coming in now, how much they have to raise in the future, where can they get in terms of revenue. And, for this company, even though we sort of have 3 years of financial projections and it's showing a 6.5x return, because it's only 3 years of financial projections, we actually look at the internal rate of return, the IRR, which is projected at around 86%. So assuming that, you know, it takes longer for the company to sell. An 86% IRR is definitely within market for this type of investment. So I would say that, you know, if you're looking at cost of equity capital for your company, if it's sort of up to Series A, the cost of equity capital should probably be considered somewhere between 45% and 100%, depending on the type of business you're in and the stage that you're at. So third one, which is a company that's a little bit further along, really great company called Journey Meditation, which is actually raising an equity round. So they're actually now in their Series C preferred. It's just a straight preferred, not participating, but we apply the same sort of analysis. So they're raising 3 million now. We're going to assume that they might have to do a 10 million-ish raise in the future. There'll be some dilution for that. But that can still actually provide us with about a 16x at least cash on cash return, and, you know, 150% IRR. So you'll see here, you know, when we look at the examples of things that are actually in the market, you know, these are companies that are making a projection or assumption that they can get to somewhere between, you know, usually $200 to $350 million in enterprise value. And based on what they need to raise, can provide, you know, IRRs of 50% and more. So as you're sort of thinking about what's market, you know, really sort of think about the fact that the cost of equity is cost of capital. Equity capital is very high, and it's important to understand that both as an investor and as a founder. So I want to thank everybody so much for joining in today. And I also really want to thank you for your patience since we had to reschedule due to technical issues. But I will send everybody who registered a recording of the webinar. I would love for you folks to visit 1000angels.com and make sure that you set up a trial account. All new members get 2 weeks free to try out 1000 Angels membership. We have 8 really exciting open investment opportunities right now, and actually several companies that are raising money that have actually found themselves in a position to help a lot and somewhat benefit from the current crisis. So would love for you guys to check it out. If you're interested in setting up a one-on-one meeting with me, I will also provide a link to do so. Happy to sort of demo the 1000 Angels platform for you, meet you, learn a little bit more about your investing objectives, and see how we can be helpful. So thanks everybody so much, and I look forward to seeing you next month for investor training with 1000 Angels.